Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bakra and I'm joined today by our global market specialists, Oriane Parmentier and Ian Vanderlaan. So we've had a week where optimism, I think, has faded slightly for a deal between the US and Iran. Markets haven't really seen the tangible progress yet that I think they needed to sustain the optimism that was priced in last week. And just as we were getting bored of the back and forth of the headlines, we have the potential reintroduction of tariffs as a risk, and we've had plenty of central banks speak this week ahead of the meetings over the next couple of weeks. So perhaps that's the best place to start. Given that the ECB is first up, let's start in Europe, Oriane. We've seemed to, or certainly over the last couple of weeks, really since the last meeting, we've had a real unanimous showing of support for a hike in June across ECB speakers. But there's obviously question marks remaining beyond that and what the policy path might look like. Did we learn anything new about their reaction function from the commentary this week?
Yeah, so first I would say I totally agree with that. The fact that we have 25 basis point hike essentially priced in now for the June meeting. The decision itself is unlikely to generate much volatility, I think. So the market is pricing about 95% chance of a hike next week, and I really think in that sense it's going to be largely a non-event that they actually hike. What really matters is going to be Lagarde's forward guidance, especially on July and September. At the moment, there is around 70 bips of cumulative hikes priced in for 2026, and September in particular is very much live. So we have about 80 basis point priced versus roughly 8 basis point for July. And this week, as you said, we've had a flurry of ECB speakers, and the tone has shifted quite noticeably, I would say, as well. I think it's become perhaps more urgent or more preemptive and, more hawkish compared to the more measured kind of data-dependent stance that we've had in the weeks before. I think that, may also reflect which speakers were actually talking this week. But I think the message has been quite consistent amongst the speakers that we've had. So they've pointed out rising inflation risks and the need to act early and decisively as well. So there seemed to have been also a concern, I would say, about second round effects and the de-anchoring of inflation expectation, even though we haven't seen that for now. But at least there were several policymakers that were warning that waiting too long would potentially carry these risks. I think in the weeks before, communication was also here more cautious and clearly kind of data dependent. I would say that as we get closer to the June meeting and with no material improvement on the Middle East situation, it makes sense perhaps for the ECB to adopt a more assertive stance, at least for June. And Schnabel also was one of the speakers this week. She has been pushing a more hawkish line since early on in the crisis, which is quite unsurprising as well. Coming from her, I would say. But what is more notable here is that even some of the doves have gradually shifted in the direction, I think, over the past weeks.
And when we think about next week specifically, what are you looking for?
So beyond the hike, which is clearly the path of least resistance at this point, I think the communication from the ECB will be key. And here perhaps maybe it's best to start with what we don't expect. We don't expect the ECB will pre-commit to a hiking cycle. They will want to avoid locking themselves into a fixed path, I think. So the reaction function should remain data dependent with a meeting by meeting approach and a strong emphasis on the geopolitical backdrop. I think given the high level of uncertainty, it makes sense for the ECB to preserve maximum flexibility and keep forward guidance to a minimum. That said, we do expect the tone to remain somewhat hawkish, which is, I think, important to mainly anchor expectations. But it doesn't mean that the actual policy stance will, won't be, as dovish as the situation allows, if that makes sense. So fundamentally, we've been saying that we didn't see a strong macro case for hikes right now, but not reacting to all the risks, was potentially going to confuse the reaction function. And I think the point that we've been making here is that for the ECB, the credibility in communication probably matters as much as the kind of economic purity, I would say. And then we'll also get a new set of projections. So on inflation, we've moved from just below 2% before the conflict to above kind of 3%, and market pricing implies around 3% for the rest of 2026 and about 2.5% year-on-year inflation for 2027. This is largely driven by energy, and so far there have been little sign of second round effects. And so we think that the ECB projection will reflect that. On growth, projection are likely to be downgraded, but we expect this to be mainly in the near term, so for 2026. But as I said, communication, I think more than the new economic projections set that we get, I think will matter here, and will drive any market response.
Perhaps we can talk a little bit about that market response. What do you expect it to do next week as a result of everything you've just run through?
Right, I would say we see a high bar for a meaningful repricing of 2026 expectation as soon as the June meeting, with the ECB likely to maintain a hawkish tone to preserve its credibility and avoid appearing behind the curve. I think the scope for unwinding hikes should remain relatively limited in the near term, except if, of course, we get a genuine de-escalation in the Middle East. But if you look at current pricing, it implies about 9 basis points of hikes for July, 18 basis points for September. So it suggests, a limited conviction on a near-term follow-through, but a more established expectation for further tightening later in the year. If next week at the ECB meeting we get a dovish repricing, expectation for the September hikes would likely fall. July, on the other hand, may prove to be more stable given less than half of the hike is currently priced in by markets. Equally, if the market shifts toward, or reacts more hawkishly, then I think the July pricing has greater room to reprice higher than September. And here, I think worth mentioning that we don't expect it would be consistent with the ECB reaction function to come up with a 50 basis point move potentially for September. So again, I think a higher potential for repricing in July rather than September here. So it's clearly a question of kind of more attractive risk reward for July versus September, I would say. Consensus on markets at the moment see September as the more likely timing for a follow-up hike, but July, I think, cannot be ruled out, especially if the geopolitical condition either fail to improve or even deteriorate. And I think in that specific case, the ECB would probably choose to move earlier rather than later to signal responsiveness and also protect its credibility. So potentially, I think even continuing to tighten until either the crisis eases or we get some sign that demand is weakening. So while I think the developments in the Middle East will clearly be key for the July decision, and it's still the July meeting is still some way off. I think there is a case that the market is probably assigning a too high probability for a September hike compared to a July hike at this point. And one kind of like comment we've we got on that specific point is that the fact that the June or the September meetings might be more live because this is when we get the new set of economic projection. But I think specifically in the current context, I would push back against that argument. And I think if the ECB sees the need to hike by July, then it will act in July and not wait for the updated macro projection, if that makes sense. Okay, so it is still a while away from the June BOE meeting, Imogen, but the market seems very convinced that they won't hike. Do you think that's a fair assessment, particularly after what we've heard this week?
Yeah, so I guess the BOE, it's sort of the same as the ECB in that the June meeting outcome, certainly when it comes to the rate decision, feels quite obvious, although for the BOE it's for no hike, whereas for the ECB we see a hike. But beyond that, it's a little bit harder to assess the Bank of England's position, I think. You know, if you were in the no hike camp at the last meeting, which, as we know, the majority of them were, or the vast majority of them were even, it was a vote 8-1 for unchanged rates. It's not obvious that there's been a huge amount, certainly by way of the data, that would change your mind. You know, we had that downside surprise in the inflation print, we had downside surprise on the labour market data as well. Of course, against that, you've had the passage of time, and that passage of time has included no deal out of the US and Iran. So the Strait of Hormuz has remained closed. Oil prices have remained elevated. And that's where Megan Green this week was starting to sound maybe a little bit more hawkish compared to when we'd heard from her just a couple of weeks ago. You know, the longer the duration of this war and this conflict, the duration of energy prices remaining elevated, the greater the risk of second round effects. And she also makes the point, of course, which is quite similar to what Hugh Pill had made just a couple of weeks ago, was that, you know, the BOE at some point needs to deliver on the hawkish path that the market is pricing. Otherwise, the market will unwind that, i.e., the Dove's argument has been that the market's done some of the work for them, but actually that can't always hold true. At some point, the market will unwind that if the BOE stops sounding like they might hike. So it sounded like Megan Green might be a little bit closer to hiking than she was just a couple of weeks ago. But Governor Bailey still seemed to be of the view that they had time. And going back to that sort of market pricing point, his view, and we've heard this from other centrists and other Doves on the committee, is that the combination of moving from cutting to hiking, as well as the market, you know, pricing in that shift from cutting to pricing in hikes, therefore doing some of the work for them, is sufficient in terms of the tightening that needs to be delivered for now. So he did lean a little bit hawkishly in the sense that he said, you know, we can't wait to see all evidence of second round effects, i.e., they can't wait till all of those effects have been felt before acting. They need to be a bit more responsive and a bit more proactive. But he generally didn't sound at all in a rush to hike. And I think, you know, it's clear that he wouldn't vote for a hike in June, and not many would, I don't think. And it's not obvious to me that he would necessarily be there even by July. So we still have our base case for the first hike in Q4, which has long been a little bit later than the market has priced in. I think the risks are still, you know, skewed earlier. It could be a Q3 hike, but it's not obvious to me that it's going to be as soon as July, because those centrist voters just don't sound in a rush to change their vote. And that's the important point, I think, when we think about the Bank of England compared to, certainly compared to the ECB. You know, it's not a consensus building body. It is one member, one vote. So it's sort of irrelevant how hawkish Hugh Pill or Megan Green or Catherine Mann sound. What we need is for those centrist voters, the Baileys, the Lombardellis of the world, to sound like they are going to vote for a hike before we can be confident that one will be delivered. And so it's those swing voters that we have to watch. And like I say, I don't think we learned anything all that new that this week about their reaction function, and they certainly didn't seem in any more of a rush to deliver a rate hike than they have previously.
Right. And last week you were talking about the unique risks, about the way in which the BOE does QT, quantitative tightening for gilts. And Bailey was talking about reserves this week, which spurred some headlines on the future of QT. What is your take here?
I think QT, quantitative tightening in the UK, always gets a bit of attention, both when we've had a period of kind of higher yields and also when there's a backdrop of discussion around the fiscal headroom, which obviously there is in the context of sort of the domestic politics in the UK. Because I think we discussed this in more detail last week, but the way that the Bank of England does QT and the way that those costs are accounted for between the Treasury and the Bank of England means that QT kind of eats into that fiscal headroom in the UK in a way that it doesn't elsewhere. So you have that as the kind of context, and then you have Bailey's comments in front of the Lord's Economics Affairs Committee around reserves, and that has spurred a little bit of a discussion on the future of QT. So basically, Bailey commented that we were closing in on what the BOE assessed to be the equilibrium level of reserves, or what they call the preferred minimum reserve range, the PMRR. And in a year or two, he thought that we might be there. So reserves in the UK grew significantly, like they did, across the globe, as the BOE created reserves to buy bonds with during its QE era, and as it lent money through its term funding schemes. And as the term funding schemes have matured and been repaid, and as the BOE has flipped from doing QE to QT, reserves have shrunk from nearly, they peaked at just shy of 1 trillion, and they're now just over 600 billion. The BOE's most recent estimate suggests that the equilibrium level of reserves is somewhere between 350 to 500 billion. So Bailey's comments this week that we're maybe 100 billion or 200 billion away from that equilibrium level would suggest that he thinks that equilibrium level is kind of at the upper end of the BOE's estimates for the PMRR, but they are often clear that they have or they don't have a huge amount of certainty over that range. So I don't think he was intending to give a particular signal by being at the upper end of that range. I think he was just being deliberately vague around a number that they have no certainty on. But more importantly, the takeaway, I suppose, certainly from the headlines that were picking up on those comments, were that because we were still 100 or 200 billion away from that PMRR level, that QT could continue in the UK for another 1 or 2 years. Now, it's not that I would push back against the conclusion that QT can continue. It's just that I probably wouldn't link the two statements between QT and between reaching that equilibrium level of reserves. The Bank of England has always been clear that it's undertaking QT with two aims. Essentially, the first is to shrink the overall reserve balance, to shrink the size of its balance sheet. But the second is also to transform the interest rate risk on its balance sheet. So instead of supplying reserves using the money that it created to buy bonds, it now wants to supply reserves through this demand-driven, repo-led system. And we can see that that's working well. Take-up in the repo facilities has increased significantly over the last couple of years. It's pretty broad-based across a large number of firms, which is indicative of kind of regular use in the system, of it being a part of firms' normal operating rhythm. And they've been effective in the sense that we've seen a significant drain in reserves. We've seen a big shift from collateral scarcity to collateral abundance. And yet we've barely seen any evidence of that in the repo market. Money market rates have remained relatively well pinned to bank rates, likely in part thanks to the effectiveness of the Bank of England's repo facilities that they created. So whilst I think that, approaching the PMRR is perhaps significant in this shift from kind of collateral scarcity to collateral abundance, I don't think it has the same implications for the ongoing timelines, for the pace of or state of QT, in that even once we reach the equilibrium level of reserves, I think QT can continue with the aim of not reducing the size of the balance sheet, but changing that composition of the balance sheet. So QT continues and reserves drain that way, but reserves are added back to the system as the use of the BOE's repo facilities increases. Okay, let's move away from the BOE and onto the Fed. We had plenty of commentary from the US this week. So, Ian, what stood out to you most this week?
Yeah, thanks, Imogen. Well, it was a sort of a mixture of this week and the end of last. But this week we have had some of that commentary trickling in, and I'd say it's actually been pretty balanced. We've had both sides of the spectrum so far. We did hear from Mega Hawk, Beth Hammock, who sort of predictably said that she's worried about inflation and that it could be time for the Fed to act soon. And then on the other side, we heard from the New York Fed President Williams, who said effectively there's really no obvious path from here, and that there's probably not a need to do anything at all. And then I would say also somewhat in the middle, we did just a few minutes ago on the tapes hear from Richmond President Barkin. He made some comments on the labor market, and I think it stood out to me that he said he doesn't necessarily see the labor market being in excess demand here or accelerating, which, notable comments given this week. We got some pretty strong labor data. I know, we're recording on Thursday, so we don't have the non-farm payrolls number in hand, but so far the jobs data, JOLTS, ADP, et cetera, has come in firm. So that's notable to see. But yeah, like I mentioned, it's still fresh on my mind. Comments from last Friday, actually. We heard from a whole slew of Fed speakers across the spectrum, half a dozen speakers or so on Friday. I think a pretty well-rounded group, and one that I would think is pretty representative of the broader committee. But they didn't, together as a group, really sound like a committee that is making the hawkish turn that I think markets have grown comfortable pricing over the last, call it 2 weeks or so. They really, at least as a group, in my eyes, felt pretty cautious, pretty two-sided. I would even say non-committal to identifying inflation as the primary concern for them, even though the market has really, I think, run with that narrative over the last week or so. And in our talks with, internal stakeholders and with clients, it's, we've heard the expectation that the Fed is shifting their focus to inflation, but we didn't really hear that on Friday. And one step further, we heard from Governor Bowman. She's definitely one of the dovish members. She's dissented a few times in recent meetings, and I would say a known Fed or Trump ally, if you will. But even still, she said that it's appropriate to look through the supply shock, the inflation impact from the supply shock, and focus instead on growth. So just flagging that, because these voices, these dovish voices, they are still present, even though, call him Uber Dove, Stephen Myron, his seat was taken by Kevin Warsh. But, I think just zooming out a little bit around this Fed speak, I think what's interesting is that I don't really see markets focused on any of this at all. It's been, all Iran focused, all headline driven. Treasuries trade softer on days when oil goes up, and they trade stronger on days when oil goes down, like today. And it's very similar for EGBs and gilts as well. But I think this is too basic of a reaction function, and it sort of discounts the dual mandate of the Fed and how they're viewing this supply shock more broadly. Do they see the risk to growth or inflation, and will they choose inflation at this the expense of growth, if you will? And I think the market is telling us that they think so, but the Fed speakers are not, at least in my eyes, fully endorsing that. So I just see a market that's really keyed into higher oil equals Fed hike, lower oil equals do nothing. And I don't necessarily think that's nuanced enough. And I'm sort of just waiting for markets to actually shift back to a stance where the concern is once again a little bit more balanced to the growth side. Higher oil price does mean potentially lower production, and I'll also add the caveat, to be fair, we just haven't really seen that in much of the data yet, or even in the jobs numbers, as I mentioned. But I think needless to say, we still continue to think the curve is a little bit too flat here. Like I said, markets are trading a Fed reaction function and an inflation fighting credibility that we continue to have a pretty significant distrust for.
I guess sort of relatedly and sort of relatedly in the sense that it's obviously, when we're thinking about those growth versus inflation risks, we had the reintroduction of a potential inflation risk this week with, the reintroduction of tariff risks. I guess that's been the other focus for you away from central banks.
Yeah, that has been one net new thing this week. The USTR, the United States Trade Representative, they put forth a new proposal on a new set of tariffs for 60 trading partners. And the rates for these tariffs would be between 10 and 12.5%. And this proposal, it uses something called Section 301, and it would effectively replace the existing tariff regime that is in place using something else called Section 122. So this hardly got any attention this week, actually. Iran headlines continued to to rule. I think there's a few reasons for this. The Section 301 tariffs, as I said, are really meant to replace the 10% baseline tariffs under Section 122, which were already set to expire at the end of July. And those 10% tariffs were really put on to begin with as a temporary measure after the Supreme Court ruled against the IEEPA tariffs all the way back in February. So these Section 301 tariffs, they're more of a permanent, definitely less legally dubious replacement for the Section 122. And I think that's probably why markets really didn't, bat too much of an eye at it. The net result, I'd say, of this new proposal, it's still in a comment period for, about a month. It would be pretty minor when we think about the effective tariff rates. Our economists already crunched the numbers on this, and they see the effective tariff rate remaining essentially unchanged from its current level using Section 301, and that current level is about 11%. So I guess I would just say that means the impact on inflation, as you mentioned, and potential growth shouldn't necessarily deviate from its current state that is sort of held since February. But I'll add one caveat there, because once these tariffs are enacted after the comment period, so call it early to mid July, we could actually see some renewed headline risk around tariffs from President Trump, because Section 301 actually includes a mechanism that gives the president the flexibility to raise tariff rates under certain circumstances. So we can't really take that 10 to 12.5%, as something that's written in stone. So we could see potential escalation under this new regime. And I would just say, as we've said before, Section 301 was used exclusively and extensively during Trump 1.0, during his first term. And we saw plenty of tariff risk then and plenty of escalation. So it's just something to keep in mind when this does go into place. Markets could be a little bit more on their toes around potential headline risk.
Yeah, that makes sense. Thank you. Oriane, what about in the euro area, away from central banks? What have you been focused on this week?
So we are starting to hear more from investors on France again. It's not entirely clear what is driving it. I think maybe a bit of fatigue around the Middle East narrative, or potentially some early positioning ahead of the summer, as country spreads tend to be supported over the summer, over that time of the year, or it could be simply a reflection of that. In the past couple of years, the budget season has brought French political risk back in focus, I would say, and seen spreads under pressure. So we started to have some conversation around the French presidential election and what it could mean for market. I think for now, the market sensitivity around political risk in France is, limited, and for the right reason. So geopolitics is still clearly the dominant driver, and I think the focus for markets. But I think it makes sense to start and have conversation on what to expect, especially for the second part of the year in France. One point I think it's too early to position for the French presidential election. It will be held in April 2027, and it's quite a long way for markets. And position, I think, can be hard to maintain ahead of the actual events. what we've seen also in the past couple of years is that being short OATs can prove to be a costly position in the absence of news in France, and especially acute political risk, with the dynamic, especially of country spread, having been to tighten in the past couple of years. This year, I think market will also have learned that, even if we get a challenging budget process like we've had in the past couple of years, they've ended up in a compromise budget being approved in the end. So we should assume that some form of budget should eventually be passed, even if it's not ideal. I think the fact that parties are perhaps less likely to be particularly cooperative ahead of the French election means it shouldn't be necessarily very easy to pass a budget. But even in the kind of worst case scenario, in a way, France has institutional backstop. So we have, for instance, a rollover special law, and I think that should reduce the risks of disruption for OAT spreads. There is also a case that sustained spread widening over the summer or this budget season is perhaps more limited than in previous years as well, because even if we get, say, a government collapse, which has been putting pressure in the past on French spreads, then we have a new, fresh set of elections coming anyway. So a new presidential election, a new legislative election in 2027. So there should be some reassurance that there could be a temporary government in the meantime, and that shouldn't have too much market impact compared perhaps to previous years. And then an interesting dynamic also is that political risk rather than fiscal dynamics have been the true driver of French spread in the past, or at least have been at the origin of a more significant widening in French spread, I would say. And I think, at this stage, whether we get a 5% or 5.5% deficit in 2027 shouldn't materially affect French spread, at least in the near term. There is an understanding that the presidential election is going to be the more kind of relevant focus for markets. And one point as well, I think, is French debt dynamics aren't particularly appealing, but I would say France is not seen as so much of an outlier anymore. Investors look at countries like Italy, Belgium, quite obviously the UK as well, where the debt dynamics are also a concern. So France less of an outlier here, I would say. Looking ahead to 2027, the political landscape is very fragmented, and I think it increases uncertainty. The far-right party, so the Rassemblement National, remains strongly positioned and is likely to reach the second round of election if we look at opinion polls. But I think the outcome here is very, very open, especially given how crowded the center ground could become. For markets, I think what really matters is not just who wins, but whether they can govern. And what point that we've been, making over and over is that true political risk and potentially systemic risk in France would require a populist president with a Eurosceptic agenda, a majority in parliament or a working coalition, and importantly as well, the willingness to implement it once in power. And this is not our base case for now, even if it's still very much early days. But in terms of scenarios and potential impact for market, I would say that a moderate president would be supportive for French spread. A far-right presidency without a majority would likely cause some widening, but I don't think we would see a systemic repricing. I think for that, or for a more significant move wider in OAT spread, you would need a populist presidency with a majority and a strong Eurosceptic stance. And in particular, the tail risk here, I would say, remains a far-left presidency, which I think could trigger a much larger and more structural repricing. Finally, one point that I wanted to make is on potential spillover. French political risk so far has remained really idiosyncratic, and I think for the French political risk to become more systemic and potentially affecting broader euro area spread, for instance, Italy, you really need to get this kind of clear Eurosceptic agenda from the new president and the ability to implement it. But I would say French political risk for now is not a near-term concern for markets, but it's gradually moving back into focus, and the risks are still clearly asymmetric as we approach the election. And what about you, Imogen? It feels like politics is still a focus in the UK as well.
Yeah, I was actually just listening to you talk, Oriane, and I was thinking, I can't wait for all the questions of, look, France, it's not a given that France can pass a budget. Why is fiscal such a problem in the UK? And if anyone's listening to this and already has that question in mind, then I would encourage you to go and listen to last week's Bondcast episode where we discussed just why the fiscal risks are so bad or so uniquely bad in the UK compared to its peers. But yeah, we've still been talking about politics. I don't think it's been driving markets so much. We're sort of in this quiet period, I guess, now ahead of the by-election on the 18th of June. So I certainly still see political fiscal risks, which are sort of one and the same at the moment in the UK, as being quite elevated. The market has calmed quite a lot. It's always difficult to know exactly what the market's pricing in terms of fiscal risk. You can look at comparing term premium across markets. We can look at the way that the vol market has moved at the long end of the curve, that sort of thing. And we can see elements that in the market that look like there is some degree of kind of cross-market underperformance, of fiscal risk at the longer end of the curve being priced in. But we tried last week to come up with a sort of fiscal risk proxy or political risk proxy, regressing gilt yields on lots of global and domestic macro and market factors, and then using the residual as an estimate for political risk. And that tells us that whilst it was obviously elevated around the time of and following the local elections, it's retreated significantly since then. I think helped very much by Andy Burnham's comments around, or rather from Andy Burnham's team, around him having no plans to change the fiscal rules. But that means, in our view, it's kind of being priced out to levels that aren't consistent with the actual degree of fiscal risk that we see existing still. So still very much of the view that can rise over the following weeks and months. And that would be consistent amongst other factors in terms of the way that we see bank rate evolving, the way that we see, Ian talked about the curve being too flat in the US, for example. That obviously has implications for the way that we see gilt yields and the shape of the curve in the UK. But when you combine all of those factors, they all push gilt yields towards our 5.25% target. Thinking just about what those risk factors are over the next couple of weeks, I think one of the points that we've been making over the last couple of weeks that I think is worth repeating is just that although we have, a degree of certainty now around some of the time horizons, and we're in this kind of quiet period ahead of the by-election, we potentially then enter a period of a leadership challenge. Nothing is a given, but risks are skewed that way. And I think it's worth the market remembering that despite comments around having no plans to change the fiscal rules, during that campaigning period of any leadership challenge, those candidates will be appealing to the party membership, not to the country at large. And if you recall, Andy Burnham's previous comments that the market didn't like around not being in hock to the bond market were at a Labour Party conference, appealing to exactly those people that are going to vote for him potentially in a leadership challenge. We put out a note around this last week, and I would say there were two key pieces of pushback around, our perception of fiscal risks in the UK, and I thought it would be worth bringing them up on the podcast just in case any of the listeners had the same pushback. The first is around, like I said, the comments from Andy Burnham's camp around not having having no plans to change the fiscal rules. It's interesting to me that the market has seemed to have sort of bought into that narrative so clearly I think I've said it on the podcast before, but it doesn't sound that different to the rhetoric in early 2024 from Rachel Reeves on the campaign trail and in the early days of her term as Chancellor, saying that the fiscal rules were ironclad. Well, they were ironclad up until the point that, she saw the detail of the public finances, and she'd been left with what she perceived to be a £22 billion black hole, and she then had to change the fiscal rules to allow for more borrowing to spend more. So Andy Burnham saying he has no plans to change the fiscal rules is not the same as, writing in a manifesto a commitment to not changing them and not changing the definition and not excluding certain things from the rules themselves. The other pushback, which we've had a couple of times, is that, well, actually, if you look at the primary balance in the UK, particularly compared to other G7 countries, it doesn't look that bad at all, which is true. But for anyone that was listening to our podcast last week, you'll know that only tells part of the story for the UK. And one of the reasons we worry so much about the fiscal backdrop is because of the net interest expense. So looking only at the primary balance, which strips out interest payments, is sort of artificially masking what the UK's fiscal problem actually is. I think I said this last week, but the UK spends so much on net interest. If it were a government department, it would be the third largest. We spend as much on net interest, or are projected to spend as much on net interest this year as we do on education, far more than we do on defence, for example. And net interest as a proportion of GDP is higher in the UK than it is in the US. So yes, the primary balance looks okay. Yes, it has been improving. Yes, it looks okay compared to peers, but that is really only half the problem in the UK. And that's, to the point is why the UK's fiscal problem is sort of so structural, if you like, because this high interest environment that we're in, the proportion of spending on net interest is very difficult to reduce. Yeah, for any government, for any incoming prime minister, whether you're on the left or the right of the political spectrum or anywhere in between, to cut debt to a degree that you would be able to meaningfully move the needle on those net interest numbers, you would have to be making very politically unpalatable spending decisions. And that's really one of the major problems with the UK's fiscal backdrop. Okay, a long one today. That's probably enough. Let's stop there. But as ever, loads going on. We will be back next week to catch up on all of these and anything else that has happened. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit like and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other NatWest podcasts, Currency Exchange and Trade Links. Thanks. See you next week.